All right. Good morning, everybody. It's earnings week. This is always the week that is the biggest in the quarter. More companies report earnings in this week than in the rest of the quarter combined. So one of the things you want to be watching for this week, any of these big names could take the market, but their earnings announcement alone, whether they, come in above the 3 or below the 3, isn't as impactful often as what is said either during the announcement or afterwards in a Q&A. Some of these CFOs, CEOs, they have weight, a lot of weight behind the words that they speak, and their forward outlook on the economy can very often drive the market in one direction or another. So we want to really be listening for how they see the rest of this year playing out. If they, are talking about imminent recession and really struggling with, supply chain issues or demand. That today in Bloomberg, for an example, when I was listening to them, they were really hounding on Coke for reducing the size of the Coke can, but increasing the costs, right? So they're putting out less product, but selling it at a higher price. And hey, we beat, yay! It's no backhand on Coke, right? Every company is doing that. But if that's what it's taking for a company to, be able to survive in the current climate, then it's unsustainable. We are still seeing an anticipated rate hike. 25 basis points seems to be a lock at this point. We're at 87% still, right? We've been kind of hovering between 85, 89, 87. We're right there. And this is just an 87% likelihood or an 87% chance that they're going to raise 25 basis points. And that would put us into 500 territory. Remember that their target goal is to get into a mildly restrictive rate. To get above neutral into mildly restrictive. The issue with that hypothesis is if you don't know where neutral is, how do you know that you passed it? And then how far past neutral do you have to go before you're mildly restrictive? If we look past May 3, and by the way, the first week of May is drama, lots and lots and lots of drama. And there's some markets closed around the world, May 3rd, 4th, and 5th. I'm pretty sure it's Bank of Japan. I'll check my notes, but there's market closes due to holiday. Maybe it's Europe, but I'll check because it's either Europe or Bank of Japan. So here we're looking at the next meeting. This is for June. If we were to hit 500 in May, which is nearly guaranteed at this point, what this is suggesting is that the pause is going to come in June, because we would still be at 500% after the June announcement, showing no rate increase. So right now, that is the baseline bet that we're going to get another hike in May and that they're going to pause in June. The trick is, are they going to announce the pause in May? Or are they going to continue with this subtle wishy-washy, gee, I don't know, let's look at the data kind of thing? The market has been saying the Fed is lying for a while now and not trusting the Fed because they know the Fed can't come out and say, we're going to pause soon. As soon as the market hears that, there's going to be a significant reaction. So the whole play has been buy the rumor of a Fed pause. And of course, you know, there's always the other side of that phrase, buy the rumor, sell the news. Once they finally announce, as bullish as it may instinctively feel to hear them say, oh, we're going to pause, and you would think the market's just going to rip to the upside, I would really approach that with caution, because we've seen the market buying this rumor. And if they're buying the rumor of a pause, they're going to sell that news. Remember that. Okay, just kind of keep that in your mind if they announce. And the Fed is kind of trapped. By the time we get into July, we're still looking at that pause being priced in. So no cut, right? Just a pause. The Fed has continued to stipulate throughout 2023 that they are not going to cut. They may pause. They've made that really clear. They're very likely going to pause, but they have been very adamant on the idea that they will not cut this year unless they have a reason to cut. And the market believes they do have a reason to cut, that we are already seeing signs of recession, and that recession is imminent and it's nearly guaranteed, and that they're going to have to cut. We're now at September, and this is where things are starting to shift a little bit between that pause, keeping us at 500, and a 25 basis point cut, which would drop us back down to 475. They're running neck to neck in probabilities right now. The September is the one you want to keep your eye on this week. Throughout this earnings announcement and all of these big names that are coming out, does it tip the scale one way or the other here? If the earnings aren't really negative and the market really likes what it's hearing, then we're likely to see the 500 rise up, that the Fed will continue to pause even as far out as September. If the earnings are less than stellar, we're likely to see a cut begin to get priced in, starting with September, and then likely to bleed out into the other announcements. So this is the one to really kind of keep your eye on. Then we get into November. At this point, the cut is the dominant thesis. And the argument is, well, are we going to cut in September, or will we have the first cut in November? Either way, this is showing that by the later part of the year, the Fed will be cutting. That's the dominant theory. Remember, it's just theory. It's the dominant theory at this point. The Fed will be cutting in the later part of this year. The only argument seems to be, is the cutting going to start in September, or will it happen in November? And then by the end of the year, it's still a dominant thesis that the cuts have started, and that we would have at least 2 of those cuts by the end of the year, taking us back down to 4.5. Remember, we're at 475 right now. European central banks on the hot seat today. They are the number one thing that the market is going to be watching, other than the earnings, obviously. There was Bed Bath & Beyond bankruptcy news. It's not the first time for this company, and if they get, if a Save-A-Ho comes in, then maybe they'll survive another year. They were really close to bankruptcy last year, and they were, pulled their bacon out of the fire at the last moment. From what I was hearing this morning, they were down 40%. We do have additional auctions today, by the way, so you'll keep your eye out during lunch. And here are your spot gamma levels for the day. We got the Qs on the right, and then SPY, then the SPX and the ES, and following that up with the NDX and the NQ. Catch your screenshot there. All right, volume's coming in just a little light. It kind of makes sense, right? It's the big earnings week. We're likely to see, you know, a little bit of reservation out of the market while it waits for some data. But it's not too low, right? If we were to say be around that 70 or even below 70, I'd be concerned. I'm not really excited about 85, honestly. But this is on the edges of still what is acceptable. So it is in the okay range, but just barely. I'm a little concerned about the low volume this morning because it implies there's something more on the docket and we're not seeing it, right? Come back in and look at that calendar again. Nothing in here stands out as being significant enough to scare people to sit on the sidelines and wait. None of these are big enough for that. So where is everybody? We did get the gap closed. So if you think about the gap between Friday's close and Sunday's open, that one is closed. And if you think about, you know, just running down through the overnight and then back up again, we are right back where we started. So a whole lot of nothing. So looking at how things went over in Hong Kong, they had an inside day breakout, but managed to pull it back in again. Still seems like there's a lot of defense along these lows and along the upper edges of this range. So they're in a really tight box right now. Seems difficult to get out of. If we zoom out and kind of put some perspective on this, they're sitting, you know, kind of mid-market. So from 2022, let's just kind of take a year's worth here. From 2022 to 2023, had the sell-off just like in our own markets. Pretty good recovery since November, kind of stalled out against these highs. Now we've got this, it looks like a pretty little bear flag, right? But it needs to follow through. And the longer that it creates the flag part of all this, the less likely that it's going to follow through, right? It should have pulled back with profit taking and then continued the move to the downside. And that's not what we're getting here. So a little bit of concern on the pattern or the shape. When we flip it around and kind of approach it from the other direction, looking at, say, fib retracements, we held the 50% line. So there's still the bullish nature off of the lows, but we are underneath the 786. So the trend is dead. Right. So now we can really parse this a little bit. Holding above 50% says that this bullish move is still intact, but the trend in there is dead since we've come up come down below the 786, and we're still holding underneath it, struggling to get through it. All right, looking at Japan, inside day, didn't even get a breakout, gapped up really strong, couldn't keep it, and really just a sideways day after Friday's indecision. We got nothing here. It looked like they were going to keep rates the same. I haven't looked at the 10-year German, so or the 10-year Japan yet, so I don't know yet about, are they maintaining their curve or not. It was at 25. They couldn't keep that stability, and it went to 50. Then during the whole banking crisis, it started to look like a seismograph, and last I seen, it was headed back to 50. So I have to check it. It's getting close to 1 o'clock in Europe, so we're past their lunch, or nearly past their lunch. Very, very tight trading range here. When it finally comes out of this range, oh boy, it's very likely going to be a significant move. That is an amazing example of an IX10 pattern. Just wow. But it needs to do the darn thing. Some of the economic data that came in today for Europe gave us this nice little spike. And, when we talk about liquidity vacuums, this seems to be attempting to close the gap, the vacuum, the liquidity gap. And we've still got the dollar holding down around that 101, 102 area. So we're just chopping down there. The low held, we can at least, give it that, but that's about all we can give it. Right now, it gave us a little bit of a gift from the 17th. So that's going to be your structure of concern. 101.50 to the downside and 102.25 to the upside. It needs to break out of this. Remember a year ago, if the dollar moved at all, there was an immediate reaction out of the S&P. Those were some good times, right? It really made trading nice. But we don't have that anymore. So now we're back to, shaking the 8-ball and using the Ouija board. So it's going to be more about levels that are breached, and then, the rate of change and the pace of the move. So when it comes to the dollar, it's not just as easy as, oh, well, it's going up or down anymore. Those days are gone. Look for a breach of that 101.5 to the downside with the target of 180 cents. And or a light TRB crossover and a breach above 102.25 with a move to 102.8. So 100.8 or to 102.8. We don't have a market maker move this morning. We've already interacted with the daily pivot point. We are inside week, and we are underneath the weekly pivot point. So that's a good start to the week on, a little bit of perspective of where we sit right now. Kind of take this out to the daily for a moment. We made it through OpEx, which was the biggest thing on the docket, right? There was this massive call wall up here, a lot of liquidity. Institutions, owned a lot of calls, and they needed out of those calls. So every time we would get up into that area, they were selling calls, and we'd come back off again. Well, that's done now. We're past all that. When I showed the spot gamma levels, that's not the only thing that spot gamma puts out. They also put out a kind of a write-up in the morning and then in the evening. On Friday afternoon, they had come out with the write-up. I don't think the morning one is out yet, and if it is out, I haven't read it. So seems like they're a little late to bring it out. One of the things that they mentioned on Friday is that the put wall moved up and the call wall moved down. So we were in a tighter range. They also mentioned that according to the flows that they see, as market volatility is likely to pick up. That was one takeaway from the write-up. And two, pressure for a downside move had increased significantly. So they weren't saying that we were definitely going to go down, because that would be kind of bold. But they were saying that looking at the flows, it certainly was pointing to more bearishness than bullishness. So the call wall is now at 41.50, and I believe the put wall had come up to 4,100. It might be 4,000 though. Yeah, right there. The put wall oscillated back down to 39 from 4,000. So it was at 4,000, it dropped to 39. The call wall was at 42 and it dropped to 41.5. So just think about where those numbers are. And what they said is that the call wall dropped a little lower and the put wall dropped a little lower. So still a pretty tight zone, but the zone is a little lower than where it was. Boy, yeah. They also reminded, and for me, it was the first time I'd been hearing of this, is a new VIX product is coming out starting today. So when it comes to the VIX, there's the VIX, which is a 1 month measure of the SPX volatility. So the VIX is just a default 30-day, but you can look at a 3 month. Just type in 3M behind the word VIX, and you get a 3 month. You can look at a VIX 6 month, and then you can look at a VIX year. You can also look at a VIX 9-day. But now you can look at a VIX 0-day. Unfortunately, it's not up yet, so I can't bring up the chart and show it to you. But when it does show up, it will be with the ticker symbol VIX 0D. I believe that is the symbol. There was a nice article that had come out on it at the CBOE. And if you're an options trader, you should be comfortable at the CBOE website. If you haven't gone there yet, oh my goodness, you're really missing out. You want to check out the CBOE, the OIC, the OCC, the CBOE. Those are absolutely amazing resources, and they're free. I like free. checking through my notes here, see if there's anything else that I missed that I wanted to cover. Is it one day? If it is one day, that one also isn't loading yet, which isn't a surprise, right? A lot of times when they come out with a new symbol, we don't see it until like 10:30. So I'll check, guys. This was more fresh in my mind Friday, but I slept since then and, maybe saw something shiny. Ooh, squirrel. The idea, though, is that with this newest volatility tool, it is designed as one more instrument to help with the 0-day trades. I think that TradyTix has the most powerful 0-day tools at this point. I haven't come across anything better than that yet, but there's so many new resources coming out every day. It's a challenge just to keep up with the ones that we would generally use, let alone any of the new ones that are coming out. And it's a nonstop process of hunting those things down. Yeah, it's a 1-day version. So Ramdo, I think you're right, Bubba. A 1-day version, a 1-day VIX would imply that instead of it saying 0 D, it's probably going to be a 1D. Sure is. Okay, so there you go, guys. VIX 1D. And it's still not up yet, right? So we're going to have to wait for that. But it's supposed to start today. So unless they drop the ball somewhere, we're going to have that. And just keep in mind, the VIX isn't dead. This is a new version. We're not seeing a new formula or anything like that. It's really the idea of what is the VIX used for, or what is it reading? If it's reading hedging activity in the SPX, and the typical VIX is looking at 30-day options structure, and how those options are traded is what moves the VIX. So a lot of trades, big trades, repeat activity in there, just hammering down on those options, we'll see the VIX move. When the institutions own a lot of junk and they want to protect that junk and they think they need insurance, they'll trade in the SPX, and that raises the VIX. They'll sell calls and buy puts, right? We see that kind of activity that changes the VIX. Well, if they're not heavily allocated in the market, they don't need the insurance, right? Why buy car insurance if you don't have a car? So if they're not heavily allocated and they don't need the insurance, then they're not buying the SPX 30-day out options. The VIX isn't moving. Instead, they're playing in the front with the 0-day because, why not? They got all this capital and they're not allocated in the market, so they might as well put it to work. And that's what they're doing. At some point, they're going to own a bunch of crap again, and they're going to need to hedge it, and then they'll be back out 30 days. But until then, the VIX is in this muted, wishy-washy, not really helpful state. And it's one of the reasons that the CBO continued to argue all through last year that they weren't going to push to change the formula for the VIX. There's nothing wrong with the VIX. It isn't broken, and they didn't want to change it. So this is a nice compromise. Instead of changing the VIX, they just added another tool, something more closely resembling the activity that we're seeing now. So I don't know. I like more information, and this new VIX will give us that. So I'm down for that. 4208 is a really big level. You're absolutely going to want to pay attention to that this week. Mark it out on your charts or whatever. If we break above last week's high, it's going to be a level that gets into focus. But right now, nothing else matters until we get out of last week's level. All right, so we've already tested the low. That low held, we've come up off of it. It is the number one thing that's in focus. Now you can mark out those levels, right? The open, the high, the low, the close. But really, I think the most immediate one, the ones that have the most weight or importance, is the high and the low of last week. Not really the open or the close. Within the intraday, there's an argument to be made that they are more valuable, right? Maybe for a little bit of analysis perspective, if there was a gap to close or anything like that, but that's really not, right, an issue at this point. And then the cog line at 4211 is the next area. And one thing that stands out when I'm looking at this monthly chart is how every time we get up into this area, it is strongly defended. So there is still a lot of liquidity up here. And every time we get close, there's big sellers willing to unload. At some point, sure, we're going to be able to make it through there, but you know, nothing yet shows that we've absorbed all of that liquidity. And as you can see with these big wicks across the bottom here, we haven't even managed to get back to the low of the 13th. Nowhere close. Anything below 4150 seems to just get bid right up. So there's certainly a lot of liquidity down here, a lot of buyers that just step in. At what point will we absorb all of that liquidity and there just isn't anything left and we finally make it down through it? Or at what point will that finally dominate and push us back up again? The range is very tight at this point. We need to get out of it. The longer we stay range bound, the bigger the move is likely to be when we do get out of it. $10-day, 30-minute volume profile. When we're at the low, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're underneath the point of control, and the point of control is nearly in the middle of all of this price action. So, you know, my famous phrase, don't diddle in the middle. For the equity trades or any kind of swing, this isn't the place to swing from. We need to get to the edge and trade a reversal, or we need to get to the edge and trade a breakout. IBD always talks about an early entry. That's what they call it, an early entry. I call it a TRB. It'd be the idea of trading this breakover. And yeah, I know it's hard to see those candles when I zoom in like that. Price is here. It's already starting the breakover. If we did get the breakover, there's some resistance at 4170, and then again at 4188, and then all the way up at the top at 42. But looking at the volume, 4175 is really the only place where there's going to be some form of liquidity resistance. And this is old liquidity, right? Volume has already happened. It's not like anticipated buyers or anticipated sellers that we would see on the dome. This is the old stuff. And a lot of valid analysis comes from the old stuff. So just because we've already had the transactions and its volume doesn't mean that it doesn't have any context or value. Likely to be a fight or a struggle to get through that area, as we've seen through all of the price so far. Below our own Globex low, there's nothing down here to assist us. I mean, nothing. Five-day, 5-minute volume profile. There's nothing to carry forward from Friday. We've already passed through the value area. There is a VPOC down at 4,100, but that's a long ways off. And I had someone ask about these light purple lines the other day. These are economic event days, open, high, low, close. So this one, for an example, is from a CPI day, and it was the low of the day on that CPI day. And then this one is just one of those. I can't tell which one because I put open, high, low, close on it. But it's one of those from a CPI day. And then there is the open on a PPI day. I don't know if they have value. That's why I shaded them really lightly so that they won't be in my face and I can look past them easy. They're not tradable lines. I don't use them for trading. They're more of, right now, they're more of me trying to answer a question. So no, they're not trading lines. Don't lean on them. Don't trust them. They're on there because I'm trying to answer a question. So far, I don't have any answers. So we do got our new week. If we compare it to last week, it is significantly smaller. I would argue that this indicator doesn't work well with the futures. Mobius did his best. It's not his fault. It's trying to read data that we can't even access with coding. So, you know, the fact that he was able to make this indicator at all is pretty phenomenal. But this is something that I see sometimes, and it's mostly that I see it in the futures. This is an unrealistic box, and I don't remember the box being that big last week. Cool thing is we can go back and watch the morning briefings. I don't think it was a box that went up to 4,300. That would have certainly got my attention. So when we compare that to this week's box, it obviously is way bigger. I'm going to argue that that box from last week is not the box that we had. The good thing is we can just jump over to the SPX, which is what this indicator was actually designed to read in the first place. We use it on everything else, but it was this entire concept of the weekly expected move all developed from the SPX. And that's what this indicator was designed to be used for. When we bring it over to the SPX, we can see that last week's box and the new week's box are very close to the same size. So not much on the volatility front as a change, but we did set a milestone last week. It is the first time since we've been focused on a weekly expected move that we didn't hit the edge of a weekly expected move within a 3-week time frame. That's never happened before. Usually by the 3rd week, somewhere along the way, we hit the edge. So now we are on week 4. We've never made it to week 4 without hitting the edges of the weekly expected move at some point. And remember, this isn't a discussion about breaking through or closing above or anything like that. It's just touching the darn thing. So my baseline bet, we're going to touch the edges. Up, down, I don't know. I've no insight there at this point. We still need price discovery from the weekend to see how the market's going to even move this morning. But I'm really comfortable with the idea that we're going to make it to the edge here this week. And the cool thing is it doesn't have to be one or the other. It can be both, because the SPX is just cool like that. All right, Bitcoin down, emerging markets are down, gold is flat. Excuse me. Bitcoin is up, bonds are up. VIX is up. Not a surprise there. K-Web is down, and tech, energy, finance, but they're not down by very much. It's one thing that really stands out this morning. Oh, Tesla had news this morning also. Apparently an analyst came out and said that even though, pricing power for the vehicles themselves might not be in Tesla's favor right now, the idea that they can sell accessories like cruise control, larger battery life, heated seats, electric windows, that apparently those are features that you can rent, or I guess rent is the right word, that you can rent. And if you don't want those features, or you decide you don't want to rent them anymore, they'll just turn them off. They think that those subscriptions can actually generate enough revenue that it changes the numbers for Tesla. So that analyst might have just pulled Tesla's bacon out of the fire, at least for a little bit. Remember when analyst recommendations come out, a lot of times it's just smoke and mirrors. It's trash. We've seen that with NVIDIA last week. An analyst came out with some pie in the sky number over just pure smoke and mirror BS, 100%. Usually what gets new traders' attention is the headline. NVIDIA gets an upgrade, Bank of America gets an upgrade, something like that. But you actually want to go in and read the backstory, or read why the analyst gave it an upgrade or a downgrade. A lot of the upgrades or downgrades are just crap. They're just smoke and mirrors. Somebody got told, hey, write up an article, make it sound good. But every once in a while, an analyst comes out with a different perspective on things. We've seen this with the Asian schools, those education centers. That was a big one back in the early part of 2022. That's one that completely redesigned two companies. One went down hard and the other one went up fast. So sometimes those analyst estimates or rate changes or analyst changes actually have something behind it, a different take on valuations. Seems to be working, at least so far. We need to see more on the day, right? Whether it's going to actually stop the bleeding. Just keep in mind, Tesla did fall a long way with its earnings, and that means on the daily, there's not a lot there for analysis yet. It needs to heal. So if you're going to try to do technical analysis on this thing for a swing, go beyond the daily. You need something that still has a chart that isn't damaged yet. I talked last week about how we were going to open today, and I was going to use that to kind of give me some guidance on a trade idea. We're not gapped down with an inside day breakout. We're just gapped down, sitting inside of where we closed Friday. So I would want to see us down below last week's candle, or at least down, closer to the low of last week's candle, that 160 area. and we're not there yet. So breaking down below that 160.56, I think would be perhaps an opportunity. What I was looking for last week when I was talking was a strong, good gap down so that we would be opening Monday down here. And I would definitely see that as bullish and, have an opportunity to trade it back up like that. Or I was looking for a big gap up, and that would be nice and bearish. And I'd be looking for, maybe a rejection across that 50% and then a move to the downside. Instead, we're getting this wishy-washy opening slightly down from where we were Friday at the close. But we got nothing here yet. So we'll let this analyst report come out. We'll see how it affects the sentiment. Kind of let the morning play on. Remember, these are weekly candles, so we don't need all of the information today. All right, the 10-year sold off a little bit, still maintaining structure inside day. Looks like it's holding at about 50%. We can measure that. It's kind of inappropriate to measure these candles because they're Heiken Ashi, and Heiken Ashi does not represent price action, but we're just getting a feel for it. So it's all right. If it really mattered, we'd get off of the Heiken Ashi. But this thing doesn't print well. And then that makes the candles hard to see, especially for a stream. So I use Heiken Ashi just to make them pop. All right, we can see that level in the dollar that I mentioned earlier, that 101.5. It is the line in the sand. So we've already tested that low. We need to see if that's going to be, if that's it. We're done with it and we're going to make our run back up, or if we break this trend line and head back down again. So far, the rally back up isn't looking good, but remember, it opens like now. The dollar opens sooner than the rest of the market. All right, there really isn't much more than that. Earnings kind of take center stage. You don't want to, trade into that earnings. You're better off letting the earnings report come in and then trading the other side of it. All right, there's no reason to guess or assume. I was going through the options data on Apple, and it really looks like traders are pricing in a bullish earnings for Apple. But even that, right, isn't enough for me to go put my money on it. I don't mind, like a lottery ticket YOLO play, but with the cost of earnings or the cost of options right now, it's hard to find anything that isn't going to cost you, a significant amount of money. If it was a real trade, putting real money on the line like that wouldn't bother me. But a YOLO play, a kind of flip a coin, go to Vegas trade, I'm not putting large money on the line for that kind of play. So, I mean, yeah, it seems more pricing for the upside move than anything else. Just, and that's not good enough. We'll have a clearer picture, right, when we get price discovery at the open. Just keep in mind on Mondays that price discovery can often take a little bit longer than on the regular day because it's got a few days of data to price into it. Other than that, everybody be careful, be safe. I'll see y'all tomorrow.